Well, howdy there, folks. In the past 24 hours, Cathie Wood just posted a video on YouTube that is very important. That's going into what stocks she thinks are going to go down next, which stocks she thinks is going to do good, things like that. And this video was put out in the past 24 hours. And what's amazing about this is essentially she had put out her big video that she puts out. I think they do it every 2 weeks on the ARC channel. And in that video, I watched that video, and that one got 100,000 plus views because everybody watches that video expecting her to say some different things, right? And in that video, she hardly said anything, to be quite honest, about her stocks, about anything like that. She was mostly talking macroeconomics. And here, this little video comes out. This is actually the one you want to watch, and no one really even knew about it, and that's why it has 26,000 views versus the other one has 100 plus thousand. Everybody was watching that one thinking that was going to be the juicy one, when really this one was the juicy one. So we're going to get into this. I'm going to react to exactly what she said in this video here, and kind of push back against some points she makes, and then maybe agree with her on a few things as well, just to kind of update you on where ARC is at the moment. It is down still, even after a slight recovery recently off that 37 level, it's still down almost 54% year to date. So, obviously ARC's just been in a very, very bad place, and, that just comes to be expected. If you're in a risk-off market like we've been, ARC's not going to do well. Just flat out. ARC is not going to do well in a risk-off market. In more risk-on, ARC's going to do well because it holds those sorts of stocks that people get excited about when the market's good. But when you're talking about NASDAQ down 20 to 30%, like the NASDAQ's been for months now, it's been down 20 to 30% range. It's not the type of market ARC's going to do well, or honestly, any growth stocks for the most part will do well. So yeah, let's jump into this, guys. But before that, I just want to shout out FTX US, the partner of the channel, the best crypto exchange out there in the world. FTX has fees that are among the cheapest from just about anywhere you'll ever find, and it's also trusted by millions of users all over the globe. And basically you get free crypto on every trade over $10, which is absolutely amazing. You might have heard of them, partner with folks like Jeremy Lefebvre and Steph Curry and Tom Brady and Jeremy Lefebvre, folks like that. Right now it is pretty amazing. Okay, you can get up to $100 in crypto by basically setting up an account and making a deposit. So it's pretty darn amazing. That will be first link in the description. It will also be pinned comment down there. And you can even set up your account to do recurring buys. So let's say you just want to buy like $20 each week of Bitcoin or Ethereum or something like that. You can automatically set up your account, so it'll just automatically buy each week. So it's absolutely amazing. Definitely get your free crypto while they still got that going on by using my link down there. It's pinned comment, and using referral code Holy Smokers to get your free crypto. It's awesome. Alrighty, guys, let's jump into this.
I thought very important, and it does address an elephant in the room. We know that innovation in the equity markets, the public equity markets, not the private equity markets, has been ravaged in the last year. It's about a year that it has been ravaged. And Raul...
Okay, I will push back against something right off the bat there that she said. Okay, I think this is very, very important for everybody watching this. The private equity markets is also getting tore up right now, okay? It's just you don't really get to see it because, who even pays attention to the private equity markets for the most part unless you're really, really into this stuff, right? Private equity markets, so for those that aren't familiar with that, it's like picture Uber, but before they went public and you could actually buy stock into it, right? Picture like all these companies that have went public, Robinhood, prior to them going public. And now in the private markets, from what I'm hearing I'm connected pretty well with some folks in the VC space, and from what I'm hearing, money's drying up fast in the VC space. Rounds aren't being raised nearly as quickly as they were before, even close to that. Funding is drying up for anybody that's even seen as remotely risky of a startup situation. So from what I'm hearing, the VC space is not looking good. It's just you don't see a day-to-day price movement like you do in the public markets. And believe me, if let's just talk about fintech. If you see Robinhood and all these other stocks down, huge Coinbase, well then who wants to fund the other companies? Because if you're going to exit, you're going to have to exit for maybe 75% lower than you thought you were going to have to exit, maybe 80%. So the VC space is a mess. IPO market, who knows when the IPO market's going to be good, and the SPACs and all that stuff. We could be waiting for quite some time until that market's healthy again. So I just want to push back against that right off the bat, okay?
Mentioned that when there is a change in expectations, and last year, as we were getting our vaccinations, the thought that the economy would open up and interest rates would go up, inflation would go up, but would be tamed. During the year, there was a change. The supply chain issues did not go away. And so this fear about what inflation and interest rates are going to do has gripped the market. First, it gripped the innovation space almost exclusively in a puzzling way. Now it seems to be affecting the market a little more broadly. But I will say now that the 2-year Treasury and the market itself has priced in at least 4 interest rate hikes, that this possibility is priced in the equity markets too, increasingly. And if anything, oil prices going up are an incredibly burdensome tax on the lowest socioeconomic demographic sectors in our economy. So I think the fears here are going to shift from rising interest rates and higher inflation, potentially to recession, especially, and you've heard me on this before, because we see inventories piling up throughout the ecosystem.
Yeah, Cathie Wood, let me say this, okay? I know Cathie Wood has gotten a lot of crap for how bad the ETF has done, right? Which down 54% year to date is obviously awful for an ETF. But let me say this. She absolutely deserves credit for her inventory call out, because she's been calling this out for many, many months now, probably 9 months plus. That she's basically been saying that in 2022 there was going to be an inventory problem, and there could even be, later on down the road into a deflation problem, because inventories pile up so much that prices on everything ends up starting to drop. I think that's a real possibility, and obviously we're starting to see glimpses of inventory rise. Look at the retailers, Walmart, Target, the biggest companies in the world, some of the most well-run companies in the world. Inventories are piling up at those companies, right? And so at the end of the day, what will end up having to start to happen will be price cuts ultimately, right? Because when those buyers start to dry up, you have no choice but to start cutting prices. And it doesn't matter what you're talking about, whether you're selling a grill for somebody's backyard or whether you're selling a house. At the end of the day, if the buyers aren't there, you got to start cutting price to attract that buyer and hope you can get somebody to bite on the sale, okay? That's business 101. That's economics 101, and ultimately that can potentially lead to inflation coming down massively and deflation as well, okay? And so she deserves credit for that. Yeah, her stocks have obviously not performed over the past year and a half, but she deserves credit for the inventory call out there. And she was honestly one of the only ones that was even making that call out too.
Stocks in the public equity markets are down, I'm going to say broadly, 50 to 75% in the last year. I mean, that's as bad as it got during 08-09. Now, in the private markets, of course, we're seeing one example after another where the pricing is up in the last year. We're seeing up 50 to 100%.
Private markets is a Ponzi scheme, okay? Basically what it is they're trying to push up the valuations in the private market because they all got money in it, right? So they need to kind of keep pushing. The problem is the exit's always been either try to get a big company to buy you out or get your company profitable, but that's never even really a possibility, or take it public. Well, dude, no one wants a piece of any of these VC companies going public right now. They don't even want a piece of these companies that have gone public. Never mind the ones that might go public. So, that's a whole joke.
And I think the private markets do have it more. They're more correct in terms of what they should be discounting right now, because of what you heard today about research, how profound the changes are, how exponential the growth will be, and how the equity market cap is going to explode in these areas. We really do believe that will be the case. Now, besides interest rates and inflation, there's been a double whammy in the public equity markets. And I think this is what helps explain what's going on. The move to risk off for many traditional asset managers means get back to your benchmarks. And if you look at the broad-based benchmarks, even the broad-based tech benchmarks or tech-oriented benchmarks, you're going to see that they are short innovation, true innovation. They're mostly in that the innovation that they're capturing is mostly in the mega cap tech stocks. They've become a disproportionate weight in many indices, and I would submit in many portfolios in the traditional asset management world.
All right, something I want to push back on here, I think it's very important for everybody watching this to understand, is I think Cathie she almost like makes an assumption that big tech is not innovative, or they can't innovate, and you have to be a smaller company to do that, right? And I think sometimes that's true, right? And historically with tech, that was true. But I mean, honestly, at the end of the day, I think some of these big techs are still innovating at a very, very high level. Are they necessarily seen or respected as innovative as maybe they once were? Whether we're talking Amazon or Apple or Google or some of those companies, no. But they're still innovative. And I listened to NVIDIA conference call, which is obviously considered a massive tech company, one of the biggest companies in the world now. The thing was amazing. And you look what companies like NVIDIA have done, and AMD, right? And so, obviously even companies like Tesla. And so I think at the end of the day, a lot of those companies hog up a lot of the best engineers in the world, a lot of the best developers in the world, okay? And those companies continue to innovate, but they're just not as respected as they once were, right? And so I think that is important to understand. You don't have to just be a small little company to innovate. You can still be a big company and innovate. And what we've seen a lot of these big techs be able to do over the years is basically be able to take whatever a smaller company is doing and just outcompete them over a period of time, right? We saw Facebook did that with Instagram, right? When Instagram launched Instagram Stories because Snapchat was a big competitor, that hurt Snapchat massively, right? They just took one of their best features. Microsoft is a big competitor to Zoom, which is a big stock, obviously Cathie Wood owns. Who's to say Apple couldn't? Apple already has FaceTime, which is phenomenal. Who's to say Apple can't create a Zoom-like product, and just make their products even stickier? So, that's kind of my opinion on this. Shopify continues to be a great innovative company. A lot of these companies, they're not your grandpa's tech companies that, got a monopoly stake and then never did anything. These ones are very, you look at the R&D they're outspending everybody. So I just think that's important to keep in mind. If you're a big dog company, it's not like it's impossible for you to innovate. I will say that.
This move to benchmark style investing, we believe has been turbocharged during the last 20 years by the tech and telecom bust first, and then the 08-09 meltdown. And the risk aversion in the markets is palpable. And so going back to benchmarks or repositioning portfolios so that they are closer to their benchmarks seems to be what has been going on. What happens then? Well, they're selling the real innovation stocks out there, the emerging innovation stocks, and those that are going to create the outcomes that we showed you in our research today. Traditional research is becoming very benchmark sensitive as well. It's not just the portfolio managers, it's their analysts. And they have also become very short term in their time horizons.
So, she's obviously bringing up a great point there. I will say that in terms of fund managers and trying to just keep up with the benchmarks and those sorts of things. But it's been that game for a long time. It's not like this is something new. At the end of the day, right, you want to try to hold on to the capital you have invested if you're a fund manager, right? And so it doesn't really pay for you to take a risk on some new company that's growing. For most fund managers, maybe a few out there, that maybe are a little more aggressive or seen that way, but most fund managers aren't. So if you go to your fund manager, the average person, what do they want to hear? Oh, I'm in oil and gas stocks and oil's been doing really good. Oh, I'm in Apple stock. Oh, I'm in Microsoft stock. Oh, yeah, because these are like brand names, like you recognize them, right? Oh, yeah, I'm in Tesla. I'm in Google. That's what you want to hear. Because the average person, that's the companies they know, right? That's the big dog companies. And so that's your safe place. If you're a fund manager and you're running money, that's your safe place. So for you to take a risk on some of the higher growth stocks, it doesn't really pay off like that, because then if you say one of these stocks and then somebody looks it up and it's like, what, you're in this stock and it's now 58% year to date? It's down 70% over the past year. Like, why do I have my money invested with you again? It doesn't pay to have the I don't want to call it the guts to invest in those sorts of stocks, but it kind of is around that vibe, right? And so you just want to try to follow around what everybody else is doing. Oh yeah, I'm in Coca-Cola and Pepsi and it's just a game.
Two other there are characterizations of traditional research out there that ARC has actually tried to capitalize on in terms of inefficiencies in the marketplace. The coverage in the traditional asset management world of analysts is broken down primarily by sector or industry or sub-industry. Very specialized, very narrow, and as I mentioned before, typically very short term. And because of the siloization, their ability to understand the convergences that are taking place between and among the 14 technologies that we touched on today, they're not able to see them as clearly as we are. We are looking for them. And so the way we've set up our research, ARC is benchmark agnostic and long-term in its time horizon. Our investment time horizon is 5 years. And therefore, our analyst responsibilities are set up in a way to encourage the collaboration and explore the convergences between and among these technologies. Their responsibilities are set up by technology, very, very different from the traditional asset management world, because we believe each of these technologies is going to cut across economic sectors. So they are specialists and they are domain experts in these technologies, and they're generalists when it comes to sectors, because these technologies are going to fall in price, and therefore access will open up to many more sectors, in many ways going mass market. So I'd like to talk a little bit.
The traditional analyst space, obviously very short-term in nature. And the reason being is those folks don't know how to fortune tell, right? They don't know how to look, 2 years in the future, 4 years in the future, and be able to say why this industry is going to do da-da-da for the most part. So most analysts are trying to cover things very short-term over the next 3 months to basically maybe out like 12 months, because that's what, they can see, and they can get guidance from companies on that. And so that's their job at the end of the day. And a lot of Wall Street is very short-term driven. Like, what's the results today? What's the results this quarter? What's the results for the next 2 quarters? Things like that, right?
Besides that, about the differentiation, we have, as I mentioned before, Brett Winton, our director of research, MIT engineer, educator, an entrepreneur, and a financial analyst for years. We have our analysts, the domain experts. The collaboration that you see is visible, and it was today on this seminar, when you listen to William talk about artificial intelligence, and then you hear our genomics analysts, Simon and Ali and Pierce as well, Sam and Tasha in the autonomous world, Sam again in the space world. Artificial intelligence is the glue that is pulling these technologies together and giving us.
What's so strange? This is so strange about kind of Cathie Wood. And there was one specific stock. It's so weird she doesn't own this one very specific stock. Do you want to know what that stock is? NVIDIA. Extremely weird she doesn't own that stock. Because from my understanding, and I've tried to do some digging, in the past of Cathie Wood before she was famous in the stock market, and from what I have heard is she used to be extremely bullish on NVIDIA. Now, she also always talks about artificial intelligence and how it's going to change genomics and all these different industries, right? Well, the company that's leading artificial intelligence, let's be very clear. They're number one, and the number two is so far behind them, it's not even funny. The number one company in the world is NVIDIA. And everybody else is far behind them, okay? And so it's just weird that she's so bullish on artificial intelligence. And from my understanding, many, many years ago, she was bullish on NVIDIA. And it's just strange that's not like a core position in the ARK fund. It's just very, very weird. Because if you're a real believer in artificial intelligence in the future, you have to be extremely bullish on NVIDIA. And you can't say, well, maybe it's a valuation, because we all know Cathie Wood will buy some stocks that have some pretty high valuations at the end of the day. So, I just think that's strange. That's all I'll say about that. Strange.
A lot to collaborate on as analysts and portfolio managers. Our research is centered on Wright's Law. That's another thing that you're not seeing in the traditional asset management world. The only way to truly size these opportunities is to understand how quickly the costs are going to fall, and what will be the price elasticity of demand. So innovation solves problems. And you heard about a lot of the breakthroughs that are going to solve problems. We saw it last year with COVID. In the last 2 years, COVID, innovation solved problems. We had tests and vaccines that no one dreamed we would have in the short time period that we got them. And it was all because of innovation. Now we have supply chain issues. We have labor shortages. We have the cost of capital going up, and we have automation of all kinds, and we have DeFi. And so we really do believe that the innovation that we are researching is a wonderful complement to the traditional asset management oriented portfolios, the traditional growth and value portfolios that are benchmark sensitive. Because if we're right, there is going to be a lot of creative destruction in the traditional world order that is represented by the more traditional benchmarks. And if that is right, then a hedge with innovation strategies is not only appropriate, but we think will be necessary.
So reading through the tea tree leaves, basically what Cathie Wood is saying right there, and it's a pretty big statement. She just kind of talking fancy words around it, essentially, is she believes a lot of these big dog companies are going down. And a lot of these smaller, innovative companies that maybe have been beaten down or will disrupt a lot of these companies. And so it's a possibility with certain of them, but it's a real tough challenge. One is a lot of these companies, the big dogs, man, they are just they're tough to compete with because they hog up so many of the best workers you're going to find out there because they have the biggest banks, right? And so that it's tough to compete with those sorts of companies. It's not impossible to beat them, but it's very, very challenging. I mean, very, very challenging. And then on top of that, those sorts of companies end up a lot of times they buy out other companies. So if they see a company that's growing, they'll just offer a buyout, right? And if the VC space is drying up, and let's say some of these companies are private and are money losers, well, if they can't get that money from somewhere, guess who's going to come? The big dogs are going to come for them, right? And so that makes it a bit of a challenge. That makes it a bit of a challenge that we have to accept, and that's what makes it hard to disrupt some of these big dog companies in any substantial way. If she's talking about the Apples, Microsoft, Amazon, Google, like these sorts of companies, it's a challenge. Even the big banks and things like that, because even those could end up buying out other competing things, right? So it's a challenge.
And I do want to talk a little bit about volatility here. Volatility has become the watchword. And as Brett said in his opening remarks, many people associate volatility with risk. Volatility is more associated with uncertainty. And when time horizons collapse, as they have within the last year, then the volatility does increase. We use volatility to our advantage. We concentrate towards our highest conviction names, and that tends to work out very well as we go through these corrections. I will say, as we go through these corrections, and in terms of the way we are being covered in the market, There are some unfortunate instances where journalists are using endpoint sensitivities, and they're kind of random, the time periods they're using, and really quite unfair.
Well, okay, once again, what she's basically saying there, Cathie Wood, she tries to, I feel like, talk around these points too much. Just say how you feel, man. What she's basically saying is the folks that have been using from where ARK peaked at, and I think it was February 21, to where ARK is now, right? And so if you show it from the peak to where it's at now, obviously it's down massively. Now, to be fair, Cathie Wood, year to date, it's also still down massively. So, I understand, if you're cherry picking from the top to where it is now, but also year to date, it's really down a lot. We could go a 3-month chart, it's still down a lot. 6-month chart, it's still down a lot. So I think that is something to keep in mind. Also, recently I looked at a 5-year of ARK versus S&P 500. And what I saw even on a 5-year basis recently was, unfortunately, ARK has even been underperforming the S&P 500 recently. I don't know as of today, but that was maybe a couple weeks ago I looked. And so that's also not obviously a good look. So, I understand she has a good, a fair thing there about trying to cherry pick the top and looking at how down it is. But also, still on any basis, it's still not good right now.
But I guess I'll close by this section by saying, inflation and interest rate risks seem to be priced in when you've had this kind of a correction, and the broader market has joined in as well. We do believe that innovation is on sale, and we do believe that it will be really important for investors to move toward the right side of change, given the amount of disruption that we do expect, and that I hope our research today telegraphed to you. It's also very important to keep that 5-year investment time horizon. The difference between linear growth and exponential growth when you're talking about a 5-year period is enormous. And because Wright's Law gets us to, I think, to the right answer in terms of the exponential growth trajectories, the surprises are going to be enormous. And most important, we like to say, as we're focusing on the 5 years, keep your eye on the prize. We realize it's been a very difficult market. We also do believe, and our conviction this past year actually has increased, that these exponential growth trajectories have been accelerated by COVID, and even more so now by the turmoil we're seeing in the labor markets, logistics, and in the financial markets.
Yeah, so I mean, Cathie Wood obviously brings up a lot of good points there and a lot of fair points, right? And some that maybe aren't too fair in my opinion. But I think the biggest reason why a 5-year horizon always makes the most sense for a long-term investor, right, is you never know when that stock's going to pop off, right? So let's for instance, Tesla. I started investing in Tesla in the first year. The stock didn't do anything or went down. I couldn't time that right. No one can time these moves right. And especially if you're investing in companies that you believe a lot and you have no clue when it's going to make that move, right? Another good example was Revolve stock. I happened to get in that stock and it went up almost immediately. Fizzy Get Dizzy was a stock I got in and it went up almost immediately. Elf on a Shelf was a stock I got in and it went up almost immediately. That was more lucky than anything I could say in a lot of those stocks, right? I always thought those stocks were going to go beast mode over the next, several years, but the fact that they just happened to go, really fast was great. And then on Tesla, on the other hand, didn't do anything for a year, and I got to just buy more shares and buy more shares. I probably bought Tesla, 8 to 12 different times, like something like that across my different accounts. And there's a lot of stocks that for the past 12 months, I've been buying and just loading up shares. And there's some of these stocks I bought 20 or 30 different times now. And I'm not done buying. I'm just going to continue to buy and increase my ownership in some of these companies I personally love. And that's why long-term horizons are usually the best. Is not just for the tax advantages, not just because that's the right way of investing, is looking at it from long term, but because you never know when that stock's going to make a move. And, if you try to time it out and maybe I'll get in it next year or something like that, it might already made that big move that you thought was going to happen. It already happens. Look at Tesla as a great example. Almost all that move happened in like a year. Like almost that entire massive upward move basically happened from, maybe a year and a half, from basically about mid 2019, right? Through about the beginning of 2021, that was where the big move happened. And so if you hadn't been on the Tesla train for that year and a half, you already missed the gains. It peaked out. And it doesn't mean Tesla won't go up more in the future. It might, right? But in terms of the massive move, that's when it happened. And so if you weren't on the train, you missed it. You missed that crazy epic move. And now you're hoping that maybe it goes from $1 trillion to $3 trillion or something like that, which is still would be amazing. It's going to be damn hard to do it. I can tell you it's a lot harder to add $2 trillion in market cap than it was to add that first trillion. I can tell you that. But, that's just, if you miss it, man, it's painful to watch those stocks go beast and you weren't part of that whole show, right? It's actually much easier, and at least in my opinion, to buy into a stock. It goes down and you buy more, and it goes down and you buy more, and it goes down and you buy more, because at least you're increasing your ownership along that way. And then it makes its move, and you're along for the ride versus trying to time it out, and then it makes the move and you weren't even there to participate. That's no fun, guys. So let me know in the comment section what your guys' opinion is. I'd love to hear from you as always. And also pin comment down there, FTX US. Get up to $100 in free crypto. Definitely check that out, guys. Pin comment, and make sure you use referral code Holy Smokers when you sign up and start trading through FTX US. And also get free crypto with every trade over $10. Much love and have a great day.